find the link to crypto research workflow template in the description and pinned in comments below. Wall Street just opened a door most retail traders don't even see, and if you misstep, you could lose everything. But if you understand this one change, you might never trade crypto the same way again. In the next 30 minutes, you will learn what a crypto ETF actually is. You will learn why institutions suddenly care. You will discover three real risks you must know, and you will get a simple checklist for beginners who want to stay safe. Stick around because the biggest twist comes halfway through and it will change how you view every price spike. If you want crypto explainers that stop you making beginner mistakes, subscribe now. We post weekly videos that help you trade smarter, not harder. People toss around the term ETF like it's magic, but it's not. It's a simple wrapper that can change who holds crypto. An ETF is not an investment, it's a container. Think of an ETF like a glass jar. Inside, you can put Bitcoin, stocks, or bonds. People buy shares of the jar instead of the actual items. That jar is traded on regular exchanges, meaning pension funds, hedge funds, and big banks can buy it easily without touching the underlying crypto wallets. That matters because this jar attracts big players with big money. More money chasing the same asset can send prices up fast and pull them down just as fast. But how big exactly? In the next section, I'll show you the exact ways institutions use ETFs and one method that almost nobody talks about. Institutions don't just buy ETFs, they use them for tools you and I rarely see. One of those tools can amplify moves by millions. There are three primary uses. First is access. Many institutions can only invest in regulated products. ETFs check that box. Second is custody. ETFs move the headache of managing private keys and custody solutions. Third is portfolio allocation and derivatives. ETFs can be used within funds to create leverage, hedges, and structured products. Imagine a pension fund adding 1% of its $100 billion portfolio via a crypto ETF. That's $1 billion flow. Enough to spike markets. That's exciting if you are long, but dangerous if you are not prepared. These flows can create volatility that wipes out small traders in minutes. Next comes the most important part, the three risks you absolutely must know before touching ETF driven crypto. Risk number one looks harmless but silently amplifies losses. Risk number two creates sudden moves. Risk number three is the one most beginners miss. Risk one is liquidity mismatch. ETFs trade on exchanges in shares, but the underlying market may be thinner. If everyone sells ETF shares at once, the manager might have to sell the underlying crypto into a thin market. Huge slippage. Slippage means someone loses. Often it's retail holders. There's a twist. Some ETFs are designed to hide this issue. I'll show you how to spot them. Risk 2 is tracking error and premiums. And it should the asset. Sometimes it trades at a discount. That difference can make returns and holding the asset directly. Buying ETF shares is instant loss. And then there's regulatory wild card, most dangerous risk. Regulators can change the rules overnight. A ban, a tax, or a custody requirement instantly remove demand or force assets. One exchange halt and ETF redemptions during the crisis. That move froze prices and caused regulatory moves and vaporize value faster than market rules. Now that you know the risks, here's the exact cyber checklist I use. But that's the mid-video surprise. Most ETFs are safer. But there's a hidden benefit institutional exploit can make retail go off. This is the secret most channels to mention. Institutions can use ETFs to funnel liquidity into derivatives and OTC desks. They create synthetic positions that don't increase actual demand. That means ETFs can inflate perceived demand without the coins available, leading to fragile price rallies. That one that can lead to a flash crash if the synthetic demand vanishes. People who confused ETF inflows with real buying feel the pain the hardest. Which brings us to the next, which brings us to the checklist, exactly what every beginner should do before even thinking of buying a crypto ETF. If you follow just 3 rules, you will avoid most ETF related traps. Rule number 2 surprises new investors every time. Rule 1 is to understand structure. Is this a spot ETF or futures based ETF? Spot means ownership of the underlying. Futures means exposure to contracts and roll costs. Rule 2 is to check the redemption mechanism. Can authorized participants redeem underlying assets, or does the fund rely on secondary market liquidity? Rule 3 is to know the custodian and insurance, who holds the crypto, and is there insurance for hacks or loss. Bonus is to monitor premium, discount, and AUM. If AUM spikes, then collapses, be cautious. Follow these and you reduce being blindsided. Ignore them and a single news headline could make your position evaporate. Next, I'll break down two real scenarios that rewards patience and one that punished ignorance. Scenario A is the long, quiet rally that built wealth. Scenario B is the sudden ETF unwind that crushed novices. The difference is in small details. In scenario A, institutions buy slowly through ETFs. AUM grows steadily, premiums stay low, and liquidity improves. Coins move into secure custody and volatility dampens over months. Retail, who dollar cost averaged, benefited. In scenario B, rapid ETF inflows created a perceived demand. Then a regulatory tweet hit, liquidity providers pulled back, and the ETF's redemption process clogged. Managers sold into a thin market and prices crashed. Retail panicked, sold. Both could have been avoided with simple checks from the survival checklist. Before the final payoff here are three tactical moves beginners can use right now. Move 1 is to prefer spot backed ETFs if you want actual coin exposure. Move 2 is to use dollar cost averaging and avoid lump sum during hype. Move 3 is to keep a portion of holdings in self custody if you value direct ownership. This is about risk control, not FOMO. The biggest increases legitimacy, but it also professionalizes the market. That means less easy money for hype chases, and more opportunities for disciplined investors who understand structure and risk. If you IPFs can be a tool, if you don't, they become a trap. Knowing the structure turns fear into strategy. That's the real unfair advantage. If you want breakdown like this, if deep dives, custody, and beginner, subscribe now and hit the bell. We make it simple and safe for beginners every week. Before you go, watch the next video where we explain liquidity and trading volume. It's the missing piece that ties everything you learned here together. You can protect your